Assalamu alaikum friends, welcome to question number 20 of SBR revision kit, and this is also a paper from your September 2018 second question. So you have been given the background of the company, the factory subsidence, sale of Naval, and these are the two requirements. Okay. So your section B question, sorry, section A question, question number 2. The pattern is this: you'll be given 2 or 3 scenarios where you have to discuss the accounting treatment, and the last question will be an ethical question. So part A, discuss the accounting treatment which Farham should adopt to address each of the issues above for the consolidated financial statements. Okay, the mark allocation is shown against the two issues. So there are two issues and how they are going to affect the consolidated financial statements you need to discuss. Second is ethical issues that you need to discuss. Also including any actions which Farham and the accountant should undertake. Even if they don't write this, you still have to write the actions. So let us go through the accounting issues. Let us first decide the first issue is for 5 marks and the next issue will be is for 6 marks. So now let us go first solve the first issue. Factory subsidence. Before that we need to read the background. Always start by reading background. Farham manufactures white goods such as washing machines, tumble dryers and dishwasher. Okay. Industry is highly competitive with a large number of products on the market. Brand loyalty is consequently an important feature in the industry. Farham operates a profit-related bonus scheme for its managers based upon the consolidated financial statements, but recent results have been poor and bonus targets have rarely been achieved. Okay, they operate on a profit-related bonus scheme. As a consequence, the company is looking to restructure and sell 80% of its own subsidiary, which is Naval, which has because the subsidiary was making substantial losses, so they decide to sell 80% of the subsidiary, not entirely. And the current year end is 30th June 2008. Now, Farham has a production facility which started to show signs of subsidence since January 2008. Subsidence means impairment. Okay, from January 2008. It is probable that Farham will have to undertake a major repair sometime during 2009 to correct the problem. Farham does not have an insurance policy. Sorry, it does have an insurance policy, but it is unlikely to cover the subsidence. The chief operating decision maker refuses to disclose the issue at 30th June 2008. They refuse to disclose. So this could be an ethical issue. Since no repair costs have been yet undertaken, although she is aware that this is contrary to the international accounting standards. The COO does not think that the subsidence is an indicator of an impairment. She argues that no provision for the repair to the factory should be made because there is no legal or constructive obligation to repair the factory. No provision should be recognized. Now, Farham has a revaluation property for property, plant and equipment. And there's a balance on the revaluation surplus of 10 million in the financial statements for the year ended 30th June 2008. None of this balance relates to the production facility, but the COO is of the opinion that this surplus can be used for any future loss arising from the subsidence of the production facility. Okay. So let us go to the factory subsidence. You need to write a proper subheading, okay, to know that which issues you are dealing with, to make it clear. So which standard you are going to use it? We are directly going to start using the standard. It is IS 36. So in accordance with IS 36, this is an indication of an impairment in relation to the production facility. You need to write the exact asset. Next, the impairment review. You need to talk about impairment review because there's an indication whether it has to be performed or not. Since there's an indication, then you have to perform an impairment review on a suitable cash generating unit as presumably. Why cash generating unit? You need to perform the impairment review because the factory as a standalone asset will not generate income for you, will not generate cash flows for Farham. You need to write this reason in your answer. It should be there that impairment review should be done for cash generating unit. So if you say that impairment review you have to do for the factory, then it's wrong. You cannot do for the factory because factory alone, okay, as an asset, you cannot generate cash flows for it, for the Farham. That's why you have to use cash generating unit. So on that you are performing the impairment review. Okay, what is cash generating unit? The definition is given here. It is the smallest group of assets that generate cash flows that are independent from the rest of the business. Definitely the whole, you can go through IS 36 to know in-depth cash generating unit and all. Okay, the recoverable amount of the unit will need to be assessed because it's an impairment. Remember two things. One is recoverable amount, higher of fair value less cost to sell and value in use. Okay, recoverable amount, you need to mention this. This needs to be assessed at the higher of. You need to write all those things. The recoverable value should be higher of this too. It needs to be assessed. Next, we are moving towards IFRS 13. This is another standard. You see, it's not just one standard, one whole standard you're using for it to discuss one accounting issue. You might need more than one. Before we were using IS 36, now we are moving towards IFRS 13 because we need to measure the fair value of the facility. So whenever the fair value is there, it is IFRS 13. So this would be required in estimating the fair value of the facility. This may involve considering whether, so how are you going to get the fair value? For the facility, you need to see the similar facilities that have been on the market or recently sold. What is their value? Okay. What about value in use? You need to talk about fair value because the recoverable amount when you're calculating it is the higher of fair value less cost to sell. So that fair value, okay, you need to talk about this fair value. Okay. Next is value in use, which is here. So how are you going to calculate this? This is calculated estimating the present value of the cash flow generated from the production facility. So whatever the cash flows you are generating from the production facility, you discount it using a discount factor. Okay. Discounted at a suitable rate of interest to reflect the risk to the business. Okay. You just have to write, even though calculations are not required here because you are not being given any discounts or any cash flows or any number, neither fair value. But you need to write these things. According to IS 36, what do you need to do? Next, we have to talk about the carrying amount versus the recoverable amount, whether it exists or not. So when the carrying amount exists, the recoverable amount, impairment has occurred. You need to write this. So what about the impairment loss? How do you deal with it? Any impairment losses is allocated to reduce the carrying amount of the asset. The carrying amount of the asset reduces by the impairment loss. So this cannot be netted off. This cannot be netted off the revaluation surplus as the surplus does not specifically relate to the facility impaired. As such, the impairment should be recorded in profit and loss. If the impairment is not relating to the facility, profit and loss. If it was relating to the facility, then it is under other comprehensive income because it is on a revaluation surplus. Revaluation surplus we record under other comprehensive income. So impairment relating to that revaluation should also go under other comprehensive income, but here it is not related. The impairment is not related to the revaluation surplus. That's why it's under profit and loss, the impairment. Okay. Because clearly they have told that just okay, none of this balance relates to the production facility. Okay, this revaluation surplus of 10 million. You cannot recognize impairment for that in OCI. It is under profit and loss. Next standard is IS 37 because they have talked about provisions. Every provision standard. So there are 3 standards in the first requirement for 5 marks, and each standard needs to be answered in a different paragraph. Okay. No provision should be recognized for the cost of repairing the factory. Okay, whenever you have to repair something, remember under IS 37, no provision is recognized for such cost. To recognize a provision, IS 37, what does IS 37 says? They would require a legal or constructive obligation to repair the factory. No such obligation exists. It is clearly mentioned in the case study. So this is a pretty simple answer. Now next we are going to the sale of Nival. This which is for 6 marks. Okay. At 30th June 2008, firm had a plan to sell its 80% subsidiary in Nepal. This plan has been approved by the board and reported in the media. This has been approved by the board and reported in the media. It is expected that old castle, an entity which currently owns the other 20%, which acquire the 80% equity, will acquire the 80% also. Okay. So the sale is expected to be complete by when? December 2008. This is they are making the plan and announcing on 30th June 2008, but actually the sale will complete until December 2008. So Naval is expected to have substantial training losses in the period up to the sale. The accountant firm wishes to know that Naval has held for sale. Accountant of this one, they wishes to show Naval as a held for sale in the consolidated financial statements and to create a restructuring provision to include the expected cost of disposal and future trading losses. The COO does not wish Naval to be disclosed. The COO, they do not wish Naval to be disclosed as held for sale, nor to provide for the expected losses. It's conflicting, right, with the accountant. The CEO is concerned as how this may affect the sales price. They are more concerned how this will affect the sales price. Remember, it's a bonus they are receiving on the profit. So if their profits suffer, bonus they will lose on it. And would certainly made bonus targets will not be met. So COO has argued that they have a duty to secure high sales price to maximize the return for shareholders. She has also implied that the accountant may lose his job. So this is like they are pressurizing the accountant to do as what the CEO says. If he were to put such provision in the financial statements, that means they are telling not to put provisions in the financial statement. They are telling to the accountant, but the accountant wanted to put. So the expected cost from the sale. So these are some expected cost. Future trading losses, legal costs, redundancy costs, and impairment losses. Included within the future trading losses is an early termination penalty of 6 million, which is there in the future trading losses under this for a leased asset which deems surplus to requirements. So many standards needs to be dealt for it. First of all, IFRS 5 for non-current assets held for sale. So you need to see whether the disposal of this subsidiary, does it come under IFRS 5 or not. So the disposal of Naval, they appear to meet the criteria to be held as non-current assets held for sale. Why? Because number one, they have showed commitment. The management has showed commitment to the sale because they have approved the plan and also they have reported it to the media. Okay. A probable acquirer also has been found, right? The sale is also highly probable, okay, within the 12-month criteria. And it is expected to be completed in 6 months after the year end. That means within the 12 months criteria. So all the criteria to be recognized as IFRS 5 is satisfied. Therefore, it is under IFRS 5. Okay. Naval would be treated as a disposal group. What is disposal group? The definition is it is a group of assets that is disposed in a single transaction. That means you're selling of a business. So when you're selling of a business, in that business there are so many assets, group of assets which are selling together in one go only. Single transaction, not one by one. That is known as disposal group. So Naval is treated as a disposal group because a single entity transaction is most likely form of disposal. Okay. If Naval is deemed to be a separate major component of business, or geographical area of group, the losses of the group should be presented separately as a discontinued operation within the consolidated financial statements of Farham. Remember, if Naval was a separate major component of the business or they were in the geographical area of the group, then that losses from that group you have to show separately. Okay, under what? Under discontinued operation. So that you are telling, okay, they appear the IFRS 5, so you need to show them non-current assets for sale. Now you are defining discontinued operations also here. So if they will be discontinued operations if they have a separate major component of business or geographical area of the group is known. Then the losses of the group will be presented in a discontinued operation. Okay. Now, since it is IFRS 5, we should know that assets which are held for sale under IFRS 5, they are valued at lower of carrying amount and fairly less cost to sell, whichever is lower. These are like rules you are writing from your IFRS 5. Okay. So the carrying amount consists of what? Remember, this is a group question. This is a selling of a subsidiary. So the carrying amount of net assets, the carrying amount will consist of one is net asset, one is goodwill. Because you are selling all your assets and everything. Goodwill also comes under net asset. Remember, when you have acquired that subsidiary Naval for the first time, you must have recognized goodwill. Now you're selling off that goodwill as well as your net assets, all your assets and liabilities. You're selling off. So you need to find the carrying amount at the date of disposal. Net assets and goodwill. Okay, so carrying amount you consist of net assets as well as goodwill relating to Naval less the NCI. Okay. Now, assets within the disposal group which are not inside the scope of IFRS 5. How are they adjusted? They are adjusted in accordance with the relevant standard first. If it is not under IFRS 5, whatever the standard relevant for that, first it will be dealt under that standard. Okay. This includes leased assets. Not all assets are under IFRS 5. Remember, some disposal group are not within the scope of IFRS 5. So for that, for example, one of it has lease assets. Okay. If you see here, included within the future operating losses. Okay. 6 million for a leased asset which is deemed surplus to requirements. The 6 million. Okay. So for this, we cannot say that it's under IFRS 5. You need to use, it's a lease, right? So this includes lease assets. So for lease assets, right of use asset deemed surplus to requirements will most likely to be written off with a corresponding expense recognized to profit and loss. What does it mean? The expense you'll be recognizing in the profit and loss, right? And the right of use asset. Leased assets. You are leased assets included means you are the lessee. Okay. Farham is a lessee, not a lessor. You're not giving on lease to someone. You are taking lease assets from someone. That's why that lease asset is there in your financial statements. So you as a lessee, what are you recognizing? Right of use asset. Right of use asset. So that right of use asset will be written off by expense in the profit and loss. Okay. Any further impairment loss which are recognized to reduce naval to fair value less cost to sell would be allocated first to goodwill and then on pro rata basis across the other non-current assets of the group. Remember, when we have an impairment loss, what should you do? It will be first allocated to goodwill and then for other assets, that also on a pro rata basis. Okay. Now, a constructive obligation is where, because see, this is part A only we are answering. Okay, so we can talk about impairment loss here, even though it's in your first accounting issue. That is the factory subsidence, you still can bring it out for the sale of naval because this is only one requirement only. So here they are talking about the provision. What is the meaning of constructive obligation? It is when the entity's past behavior and practice indicates that other parties will accept certain responsibilities. Okay, it is expected. Now, just okay. So the COO is wrong to exclude any form of restructuring provision. You cannot exclude restructuring provision. You have to include it. They are wrong to do that from the consolidated financial statements. Why? Because the disposal is already communicated to the media and there's a constructive obligation exists. So the meaning of constructive obligation is given before. That means in the past, if they've done anything like that, so that means it is expected in the future also they'll be doing it. That's why restructuring provision should be recognized. However, only directly attributable cost, but the cost relating to the restructuring, which are direct, only should be included and not ongoing costs. So ongoing cost should not be there. such as legal fees and redundancy costs, they should be provided for. Future operating losses, they should not be provided for because there is no obligating event. You need to write reasons whenever you say something is not provided for. For example, future operating losses. Why? Because there's no obligating event that in the future you will be having these losses. So no provision is required for the impairment of the owned asset, whichever the assets you are owning. Okay, for that impairment, you don't have to provide for provision, as this would have been accounted for on the remeasurement to fair value less cost to sell. Because when you were remeasuring it to the fair value loss cost to sell, it has already been accounted for. Okay, that means that impairment, because of that impairment, that has already been accounted for when you are remeasuring to fair value less cost to sell. That's why you don't have to provide a separate provision on that impairment of the owned assets. Now we are coming back to IFRS 16. If early termination penalty, this is relating to lease, okay? That means before the lease, you are canceling the lease, that then you have to pay termination penalty to the lessor. That means to the Farham will be receiving this. So if early termination penalty is likely to be paid, then the lease term has changed. Let's say it was 3 years, the lease term. Now in 2 years you are paying it. So now it's 2 years. So according to IFRS 16, lease liability must be remeasured. Remember, Farham is a lazy. So he'll be recording asset and a lease liability. So this must be remeasured now. Your lease liability will change. And it should now include the present value of the penalty, but should exclude any payment schedule after this date. Whatever it is after this date, whatever the payments you are getting, it's not included in the present value of the penalty. Okay? It is not taken as a lease liability. Only the present value of the penalty. When the lease liability is remeasured, a corresponding adjustment is posted against the right of the use asset. Same, it will affect in the right of use asset only. When your lease liability is remeasured, it will affect your right of use asset because your lease liability, that is the first figure which we use to calculate our right of use asset. So if the right of use asset has been written down to 0, an expense should be instead be charged to profit and loss. Okay, it's a long answer. It's a bit looks like a bit too much of technical stuff is here. So you definitely need to go through leases, IFRS 5 and IS 37. Part B is ethical issue. This would be a bit easier for you. Remember that whenever you are making some financial statements error, they are known as ethical issue. You can write it in your ethics, right? Even if they were accidental, even if by genuine or deliberately you are making the mistake, it's an ethical issue. So accountants, they have a responsibility for that. Okay. Now let us read. Accountants have a duty to ensure that financial statements are fair, transparent, comply with accounting standards. Now you know that ethics question always start like this. This is the starting of any ethical answer. So you can, I would say, you can memorize these points. The accountant has made mistake that would be unexpected. They have made a mistake, and this is not expected from the professional qualified accountant. You need to make sure that you write these answers there. Right? Because he's an accountant, this mistake is not expected from him. In particular, the accountant appears unaware of which cost should be included within a restructuring provision. They are not sure. And they have failed to recognize that there is no obligating event in relation to future operating losses. That means they should not recognize provision. They have failed to recognize that you cannot recognize provision for future operating losses. Accountants must carry out their work, okay, with due care and attention for the financial statements to have credibility. They must therefore ensure that their knowledge is kept up to date and they do not carry out their work and they do carry out their work in accordance with the relevant ethical and professional standards. Failure to do so would be a breach of professional competence. Okay, be very specific of which ethical principle is being breached. Is it confidentiality? Is it objectivity, integrity, professional behavior, or professional competence and due care? In this case, it is professional competence. It has more to do. Uh, it has more to do with your technical knowledge of the standard, which accountant lacks, right? They don't have that much. That's why they're recognizing all the cost as provision, restructuring provision. So this is more like a breach of professional competence. Whenever you are writing it, remember you cannot memorize this part. Okay, breach of professional competence, because from question to question this varies. Sometimes it might be a breach of integrity. Sometimes it might be a breach of objectivity. Sometimes it might be a breach of confidentiality. Sometimes it might be a breach of professional behavior. So you need to see. Okay, there you need to be a little bit aware. Okay, that you cannot, their memorization will not help you, because every case is different, so case to case. This is a professional competence. Whenever they are telling something, for example, they are not up to date, they don't have the skills, right? They are showing some lack of skills or not up to date, then it's mostly professional competence which has been breached. Okay, accountant must make sure that they address this issue through, for example, attending. So how are they going to address this issue? Remember, you have to give actions. Now it's your choice whether you want to give all the accounting issues first and then the actions as a separate paragraph, or accounting issue and action, accounting issue and second action, like that. It's your wish. Here they have given issue, that they have been breaching professional competence. Now they are giving action also in the same line. So how they must address it? By attending regular training and professional development courses. Okay. Now you have to discuss the specific impact. See, ethics means does not mean general answers. Specific impact of the error. If this error has been met, what is the specific impact for that error on the financial statement? That's what you need to discuss. So there are a number of instances which suggest that CEO is happy to manipulate the financial statements for their own benefit. She is not willing to account for an impairment loss for the subsidence, right? Even though she knows that this is against IFRS standards. She is also unwilling to reduce the profit of the group. How? By properly applying the assets held for sale criteria in relation to level, nor he wants to show a restructuring provision. So all of the adjustments required to ensure the financial statements comply with IFRS and IS standards. Okay, if they comply with this, it will reduce profitability. Okay, remember somewhere they have told that their duty is for the to maximize the value of the shareholders, to increase the share price for the shareholder. So that's why it is true that they have a responsibility to run the group on behalf of the shareholders and try to maximize their return. But they must not to be detriment though of producing financial statements which are objective and faithfully represent the performance of the group. At the same time, you have to take care of your financial statements. How are you presenting it? It has to be objective as well as faithfully represented. You cannot say, okay, I'm not going to be objective, I'm not going to faithfully represent the financial statements because I want to increase the shareholders' return. You cannot do like that. You have to balance both. Okay. So it is likely that CEO is motivated by, you always have to bring out the factor through which they are motivated. Why they are doing it. If they are being unethical, why is it so? Because they are motivated by bonus target. So they want to misrepresent the result of the group. The CEO must make sure that she is not unduly influenced by his self-interest, threat to her objectivity. She's not being objective. She's not being independent now. She's influenced by her self-interest. Okay. The CEO is also acting unethically by threatening. Don't just say he's unethical. He's acting unethically by threatening to dismiss the accountant. This is also a fact which you need to discuss in your answer. If he tries to correct the financial statements, he doesn't want to correct. Okay, the chief operating officer does not want to correct the mistake. He knows it's a mistake, but he wants to hide it. So he's saying the accountant, if you do it, you will be dismissed from the job. So it's like a threatening. It is not clear whether the CEO is a qualified accountant. It's not clear. They have not mentioned whether he's a qualified accountant or not. But ethical principles should extend to all employees. It's not just that if you are an ACCA member, all the ethical principles are only for you and not for the others. No. If you threat someone or you are trying to intimidate someone by pressurizing, this is unacceptable and it is against all ethical principles. Here, now you need to talk about accountant. All this while you are talking about the chief operating officer. Okay, the accountant faces an ethical dilemma. What is the dilemma? They have a duty to produce financial statements which are objective and fair, but to do so could mean losing their job. So now you need to write this in your answer. Okay, that on the one hand, they have a duty to show financial statements as objective and fair. On the other hand, it could mean they are losing their job. Now the actions that accountants should take, never forget it. Your last para should be your actions. They should approach the CEO and remind them of the basic ethical principles. Always it's like this, reminding whoever is threatening you of the ethical principles. This is the first action, first step, and try to persuade them of the need to put the adjustments through the consolidated accounts so that they are fair and objective. If they remain unmoved, if they're not listening to you, what should you do? Then you may wish to take some legal action or SEC ethical helpline and take legal action before undertaking any further action. Don't just say resign, resign, resign. Okay, resign is always the last resort. You should follow the steps. So now let us go to the marking scheme. For the first one, it's 11 marks, 5 plus 6. 2 marks that it's an impairment and also the impairment indicator. 2 marks for the fair value, IFRS 13. Another 1 mark, how you are going to allocate the impairment loss. Held for sale criteria, valuation and impairment, 3 marks. And required accounting treatment, 3 marks. That means all provisions and all. And for ethical, 2 marks for discussion of ethical principles. That means your objectivity and professional competence in this case and how you are applying it to the scenario, 5 marks. And the 2 marks are professional marks. They will never show you how you will get your professional marks. So let us go to the examiner's comment. This is a very short and sweet. Okay. Avoid repetition. Don't repeat same points in different paragraphs. Okay. And good practice is to have separate headings for each situation with lines left in between them for the ease of marking. Always leave one line when you're writing from next situation to the next. Part B was well answered in most cases. That means that's an ethical, right? Ethical question. But still, some were listing out just the 5 ethical principles and all those things, which is not required. You just need to link it to the case study. Okay. So that's it for question 20 and see you in the next question, question number 21. Till then, take care all of you.